Hey everyone, and welcome back to another Tesla weekly video for today. So we of course have to talk about some extra things that were mentioned after the recent earnings report and the earnings call. The full coverage for that thing is up in the top right corner, so I don't have to repeat myself in this video, which of course is just a waste of your time. But the main negative point of the earnings report was basically this, right? Tesla's automotive gross margin excluding regulatory credits have been coming down for quite a while. It's now at 14.6%. The picture does definitely not look that great. But to be honest, regulatory credits, yes, it's part of the business right now. It's part of the game. So, in my opinion, I'll take it as long as they exist. But there are some other things we need to cover in this video. Lots of analyst commentary on the quarter, some bullish, some bearish, China weekly insured numbers, and then a couple of things that were mentioned by Elon Musk on X. So if you enjoy all of that, sit back, relax, hit all the buttons. If you want to support me even further, do check out the link down in the description and hit the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So I first want to start off with something that was mentioned on X again and on a podcast with regards to the outlook. So this was already mentioned in Q1, again reiterated in Q2. So they say here the plan for new vehicles, including more affordable models, remains on track for start of production in the first half of 2025, etc., etc. They say here this approach will result in achieving less cost reduction than previously expected, but enables us to prudently grow our vehicle volumes in a more capex efficient manner during uncertain times. This should help us fully utilize our current expected maximum capacity of close to 3 million vehicles, enabling more than 50% growth over 2023 production before investing in new manufacturing lines. So this is definitely going to help top and bottom line. Now, again, this is nothing new. This was already mentioned in Q1. Moving on here to the Tesla weekly insured number. The number came in at 10,500, so remaining quite elevated. So quite a good start of the quarter, as you can see right here, well above the previous quarters. But this year, we're still down year to date, 2.8% compared to last year. But despite all the negativity around Tesla EVs as a whole, only down 2.8% year over year. That's not that bad. And if we continue at this pace, we might actually catch the 2023 number. Of course, there still is the back half of the year. Remains to be seen what happens with that. Moving on here, we got our first look at a dry cathode 4680 Cybertruck that is confirmed by the senior director of Tesla's 4680 team. Pretty cool. And now a couple of comments from some analysts. So we got here one from Piper Sandler. He raises the price target to $300, reiterates overweight rating. The reasoning behind: if there's one message investors should take away from the Q2 earnings call, it's this: sequential fluctuations in automotive gross margin hardly warrant mention in the context of Tesla's wider ambition, namely commercializing self-driving software and other AI-enabled products. Tesla's after-hours weakness, down 7.5%, likely reflects an unexpectedly large quarter-over-quarter decline in automotive gross margin, and indeed, few metrics have more impact on near-term results, hence our downwards EPS revision in 2024 and 2025. But for our part, we're with Elon. In the grand scheme, this topic matters little. Comments on full self-driving software were unabashedly positive, and as demonstrated by our 50% price target increase, bullish tweaks to the FSD forecast can easily overwhelm all other considerations. I've talked about this as well during the live stream. Most of the call was definitely focused on AI, FSD, and some robotic stuff. On the bearish side, we've got Wells Fargo here reiterating a $120 price target, underrate rating. How do we expect the stock to trade? We expect the stock to trade down. Tesla's Q2 earnings result was low quality, missing even with EV credit help, can be lumpy, although this was offset with restructuring. Auto gross margin also missed even with higher than expected sales. Additionally, the press release revealed little incremental razzle-dazzle, though we expect management to talk up FSD safety improvements, robotaxi launch, Optimus, and more on the call. Access the earnings call here. Of course, a couple of days later, we already know the answer to that. JP Morgan, they reiterated their $115 price target and of course an underperform rating. The Q2 automotive adjusted gross margin and free cash flow also tracked softer, implying negative earnings revision risk, also pointing to the trend in softer underlying results, indicating the risk of negative earnings revision is that Tesla called out higher restructuring expense entirely within operating costs and not COGS, cost of goods sold, implying no offset to the automotive gross margin miss versus consensus. They calculated the 2Q automotive adjusted gross margin of 14.6% versus their own estimate of 14.9% and consensus as high as 16.4%. Free cash generation was an inflow of over $1.3 billion, short of JP Morgan's own estimates of $2.63 billion, and company combined consensus of over $1.9 billion, and leaving the first half free cash flow at a still negative $1.18 billion, in our view posing risk for consensus free cash flow of $2.4 billion headed into the quarter. The last two here before we move into our favorite one. So we got one from Stifel. They reiterate their $265 price target, have a buy rating. So Tesla's Q2 release is a mixed bag and could weigh on the shares following the recent strength. Bears will likely focus on 1. Auto margins excluding credits missed, in part due to lower average selling prices and attractive financing. And 2. Free cash flow was slightly below expectations. 3. Second half auto margin likely continue to face headwinds. On the positive side, 1. Excluding charges, adjusted EBITDA beat the consensus by 10.8%, with margins of 16.8% versus 15.9% consensus and our 15.5% estimate. Number 2. Energy generation and storage revenue and margins easily beat expectations and growth appears strong. 3. Progress continues on full self-driving with version 12.5 rolling out. 4. Plans for lower priced model on track for the first half of 2025 and Roadster expected in 2025. We reiterate our belief that Tesla remains very well positioned long term and FSD and robotaxi impact will be critical value drivers. Last one here from Bird, I reiterate $265 price target with an outperform rating. Short-term weakness in auto margins, ex credits and bottom line miss due largely to higher OPEX and restructuring will weigh on the stock, and commentary on the call shows weaker than expected auto margin will likely spill through the remainder of the year. Energy strength and heightened regulatory credits should offset some and possibly all of these headwinds. More importantly, timelines remain intact for the robotaxi unveil, as well as the next generation vehicle alleviates concerns of a longer term pushout. We would buy this dip ahead of the robotaxi event. Now, of course, now that most of Wall Street's analysts have figured out that they should focus on what will happen in the future, FSD, robotaxi, Optimus, etc., I think there will be a switch. I think there will be a definitely switch for the overall sentiment of Tesla. I don't think we're going to see the stock drop that much, even if automotive gross margin becomes worse than expected in the second half of the year. I think most have been educated in the way that Elon wants them to think, right? It took a while, but it happened. But again, we've been saying this for a while. It will take a long time until we see some material effects financially with regards to FSD, robotaxis, and definitely Optimus. I think in the near term, it's still about the cars. It's still about selling more cars, higher margins, launch of the Tesla Semi, ramping up of Cybertruck, the Roadster, even though it's still a year away, maybe even more. But that's basically what we get from Tesla. Plus, of course, the energy side of the business, services, and others as well, because those are growing quite fast. And as they become bigger parts of the Tesla overall business, a small miss from the car part of the business will not look as horrible as it has in the past. Now, moving further, moving along to the favorite analyst here, the blog poster, Adam Jonas. So again, a whole release note here. You can pause the screen to read it all. Services hits 10% of sales. China exposure falls. AI infrastructure up 63% year to date. So I'm basically going to read this part right here. Why do they remain overweight Tesla shares? They believe Tesla has significant attributes to be valued as an AI beneficiary, but the company must see a stabilization in the negative earnings revisions within the auto business first. 2. They reiterate their overweight rating on Tesla with a $310 price target. Their thesis on Tesla is that it is both an auto stock plus an energy AI robotics company. In fact, their valuation of the core auto business is just $59 per share, represents around 19% of their 310 price target. They show us here 4 things. So 1, Tesla Services and Others business is nearing around 10% of last 12 months sales, with the shares having consistently increased since first quarter of 2022. Number 2, China represented 18% of Tesla's consolidated sales in the second quarter, down from 23% a year ago. So, of course, just being fearful of what might happen in that region, well, relying a bit less on China, definitely a good thing, although China is still a big part of the Tesla story. Number 3 and 4 talks a little bit about machinery, infrastructure, stuff like that. So maybe if we can zoom in a little bit here, AI infrastructure was $2.5 billion. That represents 5% of total Tesla's PP&E, a figure that should continue to rise in the quarters to come. 37% here is machinery, equipment, vehicles, office furniture, 22% land and buildings, and then the rest is a bit of the same, but we've got 15% here construction in progress. And so talking about AI, of course, we had a little question about it during the earnings call, and so Elon went directly to X and started a poll. We know that when these things happen, just looking at past events, you know that this has been on his mind for quite a while. So he asked here, should Tesla invest $5 billion into XAI, assuming the valuation is set by several credible outside investors? I voted yes, heat of the moment. Maybe I should have voted no. 5 billion is not that much. Plus, I mean, you can use Llama 3.1. It's open source. You don't have to pay for it. Of course, you don't really have to rely on Facebook or Meta because it is open source. But okay, I mean, there's more to XAI than just an LLM right now or in the future, I would say. $5 billion. Okay, I mean, I would have loved them to buy or acquire a stake in XAI when it was not valued at over $20 billion. But okay. And it looks like the public is in favor. We'll discuss with Tesla board. To which Gene Munster here shared his thought. Some perspective on the distant potential that Tesla invests $5 billion in XAI. Bottom line is this would have a material benefit to XAI, given it would almost double XAI's capital raise to date. As for Tesla, the impact would be more subtle. If XAI's post-money valuation was $29 billion, the recent round was $24 billion post-money, this implies Tesla would hold 17% of XAI. Assuming no dilution and XAI reaches a valuation of $200 billion in the next 5 years, it would add just over 4% to Tesla's market cap, so $30 billion. From a return on capital perspective, it's a 600% return over 5 years. That's great. My recommendation, his recommendation that is, Tesla should invest $20 billion into XAI to move the needle for investors. So basically acquiring the whole company. Close to. I don't think that's realistic. And again, why should XAI reach $200 billion in the next 5 years? So what do you think? Should they invest? Should they invest 5? Should they not? Should they invest more? Let me know down in the comment section below. Moving on to the last part here, so a couple of comments on FSD 12.5 and hardware 4. So I wish we could know if 12.5 will banish or actually smart summon. This was tweeted by Peter. So Elon Musk here says, yes, technically, actually smart summon is a separate code, but it will be bundled with other versions of 12.5 next month. We're focusing on just Model Y with hardware 4 for the initial release. Make sure that that works well, then broaden. This has the 5x increase in parameters. Hardware 3 would run the same parameter count, but requires extra work to optimize the code. So if you have a Tesla with hardware 3, in my opinion, don't get your hopes up just yet. And with regards to hardware 4, we have yet to unlock the full potential of that. That may enable up to a further 8x increase in parameters. Remains to be seen when that will actually happen. And so right now, looking at the graph, of course, we had that nice breakout of the huge downtrend that started back in November of 2021. Of course, with the last two red candles on the weekly, now the question is, can we rebound over that downtrend line? Yes or no? The 200-day moving average does sit quite close to it. It's at $203. The 50-day one at 210, which is bang on that downtrend line. And the 20-day one sits at $234. Of course, previously RSI was high, not overbought, but now with two weekly red candles, RSI did come down a little bit. So we are having some negative momentum right now for Tesla. Of course, it's earnings season, so a lot of companies' earnings can impact the broader market. Right now, for me, I haven't changed my mind since the last Tesla video. I'm not buying more shares at the moment. It's earnings season. I have cash on the side to add to other positions. I think it's going to be quite volatile in the next coming weeks. Plus, of course, robotaxi event towards the back half of the year, well, later half of this year. We've got elections coming up, lots of events happening. So have some cash to try and buy the dip. That's about it for this video. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. We appreciate that. And I see you all in the next one. Bye-bye.